Preparing for FP&A at Capgemini interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Tell me about your experience in FP&A and how it would support Capgemini's business. My FP&A experience combines reporting discipline with commercial understanding. I have prepared monthly forecasts, analyzed revenue and cost variances, maintained planning models, and explained results to operational leaders. For Capgemini, I would connect financial performance to utilization, project margins, staffing, subcontractor costs, and pipeline conversion. I also emphasize automation and control because reliable data lets managers act quickly. My objective is not simply to report what happened, but to clarify why it happened and what decision should follow. While answering, focus on budgeting, forecasting, management reporting, variance analysis, stakeholder communication, and how your experience supports a global, project-driven technology and consulting services environment. Question 2. How would you build an annual budget for a consulting and technology services organization? I would begin with strategic targets and translate them into operational drivers. For a services business, that means analyzing backlog, pipeline, billing rates, utilization, headcount, attrition, subcontractor usage, and delivery capacity. I would gather bottom-up assumptions from business leaders, challenge inconsistencies, and reconcile them to top-down expectations. After review, I would document assumptions, approval owners, and sensitivities. The final budget should be an actionable operating plan, not merely a finance submission, with monthly phasing and measurable accountability. Make sure to cover revenue drivers, resource capacity, utilization, billing rates, headcount, subcontractors, operating expenses, regional inputs, assumptions, review cycles, and alignment between bottom-up detail and strategic targets. Question 3. What is your approach to forecasting revenue in a project-based business? I separate revenue forecasting into contracted work and probable new business. For existing projects, I use remaining backlog, milestones, planned effort, billing terms, and expected completion dates. For pipeline, I apply stage-specific probabilities and realistic start dates rather than treating the sales forecast as guaranteed revenue. I reconcile the model with staffing and delivery capacity, because sales cannot convert without resources. Finally, I compare forecast revenue with recognized revenue and billing, investigating timing differences before publishing the outlook. In your answer, talk about contracted backlog, project milestones, time and materials, fixed price work, pipeline probability, resource plans, billing schedules, revenue recognition, and regular collaboration with delivery and sales teams. Question 4. How do you analyze a monthly budget versus actual variance? I start by identifying material variances against both budget and prior forecast, then decompose them into volume, price, mix, timing, foreign exchange, and one-off effects. For example, a margin shortfall may reflect lower utilization, delayed hiring, a billing rate issue, or an incomplete accrual. I validate the explanation with the responsible manager and supporting data, then distinguish temporary timing from structural deterioration. My commentary ends with an action, owner, and expected financial impact rather than just describing the variance. Be sure to mention materiality, price-volume mix analysis, timing, accruals, foreign exchange, one-time items, root cause ownership, corrective actions, and separating accounting noise from genuine operational trends. Question 5. What key performance indicators would you monitor for Capgemini's services business? I would monitor revenue growth, bookings, backlog, utilization, average billing rates, realization, project gross margin, headcount, attrition, subcontractor costs, operating margin, and cash conversion. I would also track forecast accuracy and pipeline coverage because they indicate planning quality and future visibility. The key is understanding relationships. Weak utilization can pressure margin, while strong bookings may still create cash strain if billing lags delivery. I would standardize definitions and investigate movements by geography, service line, client, and project stage. Focus on revenue growth, bookings, backlog, utilization, realization, billing rates, gross margin, project margin, headcount, attrition, subcontractor spend, cash conversion, and KPI definitions that remain consistent across regions. Question 6. How would you explain a revenue shortfall to a non-finance stakeholder? I would explain the shortfall in business language, beginning with the size and significance of the gap. Then I would identify the operational drivers, such as a delayed project start, lower client demand, staffing constraints, or milestone slippage. I would clarify whether revenue is permanently lost or merely deferred, quantify the margin and cash implications, and outline corrective actions. For example, I might recommend accelerating approved work, reallocating available specialists, or revising the forecast to reflect updated evidence. Make sure to cover plain language, factual evidence, operational drivers, financial consequence, distinction between timing and lost demand, corrective actions, and avoiding blame while preserving accountability. Question 7. Describe a time you improved an FP&A process or reporting model. In one role, monthly reporting required several manual spreadsheet consolidations and took 5 business days. I mapped the process, standardized data definitions, automated recurring calculations, and added validation checks before management review. I also created a concise dashboard linking actuals, forecast, and key operational drivers. The cycle reduced to 2 days, manual errors declined, and managers received earlier insight into margin risks. I preserved an audit trail and documented ownership, so the improvement was sustainable rather than dependent on one individual. In your answer, use a clear situation action result structure and quantify improvements in cycle time, accuracy, automation, transparency, control quality, user adoption, or decision-making effectiveness. Question 8. How do you ensure accuracy and control in management reporting? I build accuracy through preventive and detective controls. I reconcile reporting outputs to the general ledger or approved source systems, validate period cutoffs, investigate unusual movements, and use standardized KPI definitions. I maintain controlled templates, clear version naming, documented assumptions, and review sign-offs. For recurring reports, I add automated checks for missing data, duplicate records, and unexpected margins. If an issue remains unresolved, I disclose it rather than hide it, explaining the likely impact and planned remediation. While answering, focus on reconciliations, source system integrity, standardized definitions, variance checks, review evidence, version control, segregation of duties, documentation, and escalation of unresolved exceptions. Question 9. How would you forecast headcount and personnel costs? I would begin with opening headcount by function, grade, location, and cost center. Then I would model approved hires using realistic start dates, expected attrition, promotions, salary increases, bonuses, benefits, and currency assumptions. I would distinguish billable delivery roles from support functions and connect workforce levels to revenue capacity and utilization. Each month, I would reconcile actual movements to the plan, explain vacancies or timing changes, and update the forecast using confirmed hiring activity rather than aspirational requisitions. Be sure to mention opening headcount, approved requisitions, hiring timing, attrition, promotions, salary increases, bonuses, utilization, local currencies, vacancies, and reconciliation to workforce strategy. Question 10. What is the difference between a forecast, a budget, and a rolling forecast? A budget is the approved financial plan and performance benchmark for a defined period. A forecast is the latest unbiased estimate of what the business now expects, incorporating actual results and updated assumptions. A rolling forecast continuously extends the planning horizon, such as maintaining 12 or 18 forward months. I would not use the forecast to rewrite accountability for the original budget. Instead, the budget measures performance, while the rolling outlook supports resource allocation, risk management, and timely decisions. In your answer, distinguish approved target, latest expectation, and continuously extended outlook. Explain purpose, timing, accountability, scenario use, and how each supports different management decisions. Question 11. How would you investigate declining project margins? I would compare the original estimate, current estimate at completion, and actual cost to date. I would examine staffing mix, hours, utilization, overtime, subcontractor rates, rework, scope changes, billing leakage, and milestone timing. For fixed-price work, I would assess whether delivery effort exceeds the remaining budget and whether contract amendments are possible. I would then quantify the expected margin impact, update the forecast, and agree actions with the project manager, such as repricing, scope control, resource changes, or escalation. Focus on contract type, scope creep, staffing mix, utilization, overtime, subcontractor rates, rework, billing leakage, milestone delays, estimate at completion, and corrective action with project leadership. Question 12. How do you manage competing deadlines during month-end and forecast cycles? I prioritize activities according to reporting impact, dependency, and deadline. I maintain a close and forecast calendar, request inputs early, and identify critical path items such as accruals, revenue data, and headcount changes. I use standardized templates and automation for repetitive work, reserving time for analysis and review. When deadlines conflict, I communicate the trade-off quickly, agree priorities with my manager, and protect control checks. Speed matters, but a fast report containing avoidable errors creates more work downstream. Make sure to cover prioritization, critical path activities, close calendar, stakeholder dependencies, early data requests, automation, escalation, quality safeguards, and communicating trade-offs when deadlines conflict. Question 13. What would you do if a business leader challenged your forecast assumptions? I would first understand which assumption the leader disputes and why they believe a different outcome is more likely. I would present the supporting evidence, including historical performance, current backlog, pipeline data, staffing constraints, and comparable projects. If uncertainty is genuine, I would show base, upside, and downside cases with quantified impacts. I would seek agreement on the most defensible assumption, document the rationale, and define indicators that would trigger a forecast update. The aim is credibility, not winning an argument. In your answer, emphasize listening, evidence-based challenge, transparent assumptions, scenario analysis, sensitivity ranges, shared objectives, documentation, and escalation only after constructive resolution efforts. Question 14. How do you use Excel or other tools in FP&A? I use Excel for structured modeling, sensitivity analysis, pivot-based investigation, and management-ready outputs. I am comfortable with formulas, lookups, conditional logic, Power Query, and controlled templates, while using dashboards or planning tools for repeatable reporting. I keep models transparent by separating inputs, calculations, and outputs, and I include checks for completeness and reasonableness. I also avoid making Excel the sole source of truth. Key data should come from governed systems, with clear ownership and documented refresh procedures. Be sure to mention advanced spreadsheet skills, data cleaning, Power Query or equivalent tools, pivot analysis, scenario modeling, visualization, ERP or planning system integration, controls, and avoiding opaque models. Question 15. How would you assess whether a new project or contract is financially attractive? I would evaluate expected revenue against direct delivery cost, internal labor, subcontractors, travel, technology, overhead allocation, and implementation effort. I would test staffing, utilization, billing rates, scope, payment terms, milestones, and likely change orders. For fixed-price work, I would include delivery risk contingencies and an estimate at completion. I would assess gross margin, cash timing, and downside scenarios rather than relying on headline revenue. Strategic value may matter, but it should be explicit and approved, not hidden inside optimistic assumptions. Focus on revenue, pricing, delivery cost, staffing assumptions, utilization, gross margin, cash timing, working capital, risk contingency, contract terms, strategic value, and scenario analysis. Question 16. How would you explain the relationship between profit, cash flow, and working capital? Profit reflects revenue and expenses when accounting rules recognize them, while cash flow reflects when money is collected or paid. A profitable project can consume cash if employees and suppliers are paid before the client is billed or collected. In services, I would monitor receivables, unbilled revenue, deferred revenue, billing milestones, and overdue balances. I would connect forecast profit to cash timing and highlight working capital actions, such as accelerating invoices, resolving disputes, and improving collection discipline. While answering, distinguish accrual profit from cash movement and discuss receivables, payables, unbilled revenue, deferred revenue, billing milestones, collections, and why profitable projects can still create cash pressure. Question 17. How do you collaborate with controllers, accounting, and operational teams? I view FP&A, controllership, and operations as complementary. Accounting provides reliable actuals and policy guidance. FP&A interprets performance and outlook. Operations explains the underlying activity and executes improvements. I establish clear deadlines and ownership, reconcile reported results before analysis, and resolve data differences at the source. I also avoid presenting finance as a policing function. By translating accounting outcomes into utilization, staffing, project, and client drivers, I help leaders understand both the numbers and the actions required. In your answer, cover clear ownership, close coordination, reconciliations, accounting policy awareness, operational drivers, issue resolution, shared definitions, constructive challenge, and translating financial data into actions. Question 18. Tell me about a time you found an error in a financial report. During a monthly review, I noticed a project margin moved sharply despite stable operational activity. I traced the change to a duplicated subcontractor accrual caused by a manual upload. I validated the issue with accounting, quantified the impact, corrected the report before distribution, and informed the controller and project lead. Afterwards, I added a duplicate record check and required source reconciliation before consolidation. The experience reinforced that unusual movements deserve investigation, even when the total company result initially appears reasonable. Make sure to use a concise STAR example covering detection, validation, materiality, communication, correction, root cause, control improvement, and the lesson learned about professional skepticism. Question 19. How would you handle differences between actuals in the ERP and an operational planning system? I would not manually force the numbers to match before understanding the difference. I would compare period, entity, currency, account mapping, project identifier, source timestamp, and transaction status across both systems. Then I would classify the variance as timing, mapping, interface failure, missing transaction, or legitimate scope difference. I would reconcile material items with accounting and system owners, correct the source where possible, document any approved bridge, and implement a recurring control so the issue does not return. Be sure to mention data lineage, period and entity mapping, chart of accounts, currency, timing, interfaces, reconciliation ownership, materiality, correction process, and preventing recurring differences. Question 20. Why do you want to join Capgemini in a finance controller or planning analyst role? Capgemini appeals to me because its global technology and consulting business creates a complex environment where finance can materially influence growth, delivery, and profitability. I am interested in combining controllership discipline with forward-looking planning, especially around project performance, workforce capacity, utilization, and cash. My strengths are structured analysis, clear communication, and process improvement. I would bring reliable reporting, constructive challenge, and practical recommendations to business leaders while continuing to develop in a large, internationally integrated finance organization. In your answer, connect Capgemini's global technology services platform, transformation agenda, finance complexity, analytical strengths, stakeholder orientation, career motivation, and specific contribution to better planning and control. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.